I'm Charlotte McLeod with investingnews.com, and here today with me is Peter Grandich of Peter Grandich & Co. Thank you so much for joining me. Always great to have you here.
Always a pleasure to be with you, Charlotte. Thank you for having me.
Really nice to be catching up. It's been a little while. I was looking back. I think we last spoke all the way back in February. So I thought it would be a good time for us to take a look back at the first 6 months of the year for gold. Of course, we've seen the price reach record levels. Now we're in a little bit of a pullback. But could I get your takeaways on gold during the first half?
Sure. So it is done. You get a little nervous when it does mostly what you hope and expect it to, especially over a long period of time, because you have to learn to say the words, I was wrong in this business, or else it'll never last. But it reached a peak. It was at a point when it got close to 3,500 that I actually sold physical bullion so I could get more exposure to mining shares and juniors, and the belief that there'd be a consolidation period for gold. I had hoped that it would last the entire summer. And the reason is I felt, one, I'm a big believer in moving averages in commodities, and the moving average of gold where it was versus where the moving average was, the 200-day, was so far that it almost had to stop running, which it did. And now that moving average has crossed over 3,000. And if you want to believe in 4,000 or 5,000 or more in gold, which I do, the longer this consolidation period would go, the more benefit it would be to reach that. So I'm as pleased as anything. I think the reasons why gold did what it did, it's always easy to look back, are still valid. Central banks are major buyers. Many of those banks are associated with the BRICS movement. The BRICS movement is moving forward no matter what Donald Trump wants to try to say about it. And people are starting to realize that there are a lot of other issues, both domestically as well as worldwide, where gold has become affordable. I would like to make one point, if I may. I've tried to do this in interviews. It's not often discussed because there aren't old dinosaurs like me left still talking. But when I started way back in the dinosaur age of the early 1980s, the U.S. stock market for 13 years traded just between 700 and 1,000. In fact, people were so bearish on stocks that there was a famous Business Week front page story called Equities Are Dead. That they never saw the stock market ever going up much again in their lifetime. And a young man came out of Gainesville, Georgia that no one knew of, named Robert Prechter Jr. at the time. And he predicted a 3,600 Dow based on something no one knew about called the Elliott wave theory. And I remember my broker, I was a warehouse manager, and I remember him scoffing. He said, who's this kid? What does he know? The Dow never goes over 1,000. Well, we all know. I'm not saying gold's going to go to 40,000 too. What I do want to suggest to gold people who've been in it for a lot of years, who saw it trade basically in a range for a lot of years, don't get caught in this concept of people that have been bearish going, it has to go back because it's so far higher than it used to be. No, that's not the case, especially given the fundamental argument now for gold. I would just say that it would be hard pressed to see gold much below 3,000 anytime within, as far as our eyes can see, but a very strong chance of 4,000 or 5,000. So you still need to look at gold favorably, in my opinion.
I think that's a great sum up of what we've seen so far in the year for gold. And I think maybe provides some reassurance to investors. I know a lot of people are looking at this pullback. They got used to seeing gold just go up, and they're worried about what might be happening now. So really good to go into that. I wondered if you could say more about how your strategy is looking right now. You mentioned you sold some physical gold so you could get more exposure to the gold stocks. Can you talk a little bit more about that?
Sure. So the first thing I did was the majors, because they were starting to print money. Their record free cash flow, which is only continuing and getting better, was a reason to think that they would be more leveraged to than what the gold price itself could go up. The important thing there also is to understand is that gold goes up $100. Their costs aren't going up to match that. So the gold producers, the significant gold producers, should continue to see record cash flow and therefore can still be owned here. Where I then switched into, and the nickname I gave myself years ago, and it's appropriate, Riverboat Pete, is the most riskiest, and that's the junior resource stocks. A market that 2-3 years ago, most of us who were still in it felt we were dead. That somehow, whatever reason, somebody closed the door and we weren't watching, and we're caught in this horrific zone that we'll never get out of. That market is lifted, but it hasn't taken off yet. And I think that's the next big story in the metals, that the juniors, the little guys and gals, that many times, failure is the norm. Not all of them are going to find mines at all, but the market in itself is going to be lifted. And one of the reasons is because the metals have become so prominent and become mainstream stories. I've heard more people talking about copper who will be considered generalists, not people who, like you and I, that spend a lot of our time in the metals market, who really don't spend any time. But because they heard, hey, it was tariffs were put on it, and then they learned about the story and the supply and demand, are now shopping for ways to play for it. And that will come down to the junior market. So I feel really good, not only for gold and silver and copper and uranium, which I went back into after having the best returns I ever had in my life in the first go around. And in April, got very fortunate to buy them back at the lows again. But we're in a really near perfect storm. Now, somebody will go up, sell. Grandich said it's a near perfect storm, but we really are for copper and uranium, especially. The supply and demand scenario is so powerfully bullish that there's nothing really to be seen other than price appreciation getting too far ahead to really stop it from going up. So I really feel very, very good compared to any other time. I always feel good when you speak to me. I don't sound that way. But in terms about the markets, I feel really, really good. And I feel really good for where I pushed a lot of chips in, that we're seeing progress now. And I think it's set to take off as well, meaning the junior market.
I know what you mean. And I think I can tell even just from your voice that you're feeling better than you have in some of our previous discussions. And you hit on a point that I really wanted to ask you about, because we talked before about the stock market, the general stock market, how it was priced to perfection. This could be a distraction for people who are interested in those other kind of trendier things. But now, so it sounds like you're seeing people actually now are paying attention to maybe to those big gold miners results, and they're starting to get into the sector, and that's going to be trickling down. Anything you would add on that?
Sure. So they're not rushing here yet, because still what they focus on is still doing pretty good. The general equity market, whether it should be there or not as well, cryptocurrencies, which was the biggest negative towards the junior resource market, is doing good. It's lead, is making new highs. But where you're seeing the interest particularly is on the institutional end. For instance, a few fund managers have said to me, hey, I could have bought all the junior private placements I wanted 2 years ago. Now I can't even get 25% of what I'm asking for. And they're no more best efforts deal. They're bought deals. Generalists, one company that I'm involved with has put on a series of presentations to institutions, and over half the people in the audience, and all of them, were not people who were precious metals money managers. They were just general money managers. So their ears are open. They're not going to go right to the bottom of the peg and start buying juniors. They're going to start with the majors, but then become accustomed to it, and then doors will open and things of that nature. And that's one of the other main reasons that I feel really, really good about it. And the fact that the argument for the metals itself shows no real downside to them of a significance, and therefore it seems all systems are go.
I definitely want to move over and ask you about copper and uranium. But just before we do that, I want to get your thoughts on silver. So I remember from previous conversations, you haven't been such a fan of silver. And I wondered if that has changed at all now that silver seems to be on the move. What are you thinking?
Well, it did. When it went under 30, I put out a big thing. I put this silver dome on the top of my head and the writing and all. Because I used to say, people used to ask me, Mr. Grandich, what do you think of silver? And I said, well, it's like kissing your sister. So that changed, and I put it on the same level. In fact, about 2 months ago, I wrote that I think it's about the lead gold, that it could actually go up more percentage wise. So I'm a much better believer in it. I still will not overweight myself in it, but I would have as much silver as I would have gold now. And of course, the silver mining stocks and all. But my favorite for this year was, and still remains, is copper and uranium. And so I would say that uranium and copper are battling it for first place, but right close to them second is gold and silver.
Okay, fair enough there. And let's move over then and talk about copper. I am really interested in getting your thoughts here because it's been making headlines over the past week and a half or so because of the Trump tariffs that have been discussed. I have typically heard about copper as a longer term story. And for me, I'm wondering, okay, does this mean the time frame for copper has moved up? How are you seeing those tariffs?
So go back a year or 18 months, even the bullish copper viewers still felt it wasn't going to be to 2026 before it could really take off. I was not in that camp. I began the year when it was just on either side of 4 saying, I think it's going to surprise us and be at 5 or above by the end of 2025. Well, it's certainly gone beyond that because of the tariff situation. And that tariff situation is likely not to stick. It likely won't be 50%. It'll drop. And if copper was still at the price where it is now, it'll probably pull some. But I think it's going to be difficult to see copper under 5 again. It may for a brief period of time. And the reason, Charlotte, is unlike any other cycle in the 42nd year that I'm in, there isn't an ample supply out there. So even if the economy slows, because that's what everybody used to say, it's stock to copper. As soon as the economy slows, demand for copper dries up. All this excess copper that's out there, people funnel in and the price comes down. That doesn't exist anymore. And there's 2 other problems that are bullish for copper. One, the world has shrunk much shorter. It used to be you and I could have been at a mining conference 20 or 30 years ago, spin a globe, didn't matter where we looked, could hit a country and go, yeah, we can go there. Not anymore. It shrunk a lot. Here now, just in West Africa, we just seen in Mali, the country basically fly in and take $100 million worth of barracks gold. I think mining companies are going to be extra careful where they go. So that shrunk. Then the social and political problems, particularly in places where copper was predominant. But the other issue in copper is the grade has dropped off. The standard grade now being produced is less than half than it was 10 or 15 years ago. So it's going to need a substantial price above 5 before billions and tens of billions of new money is going to be into even good areas be chased into it. So I think it has strong support. I think the most ideal thing, and of course I'm talking my own book here, the one stock that I have the most money in is a gold copper play. But I think if you can get both of those in a play, which more of the mining companies now are focused on, Barrick would call itself the most pure gold play 20 years ago, now is one of the biggest talkers about copper and all. So copper and gold combined is probably the 2 best assets that you can get together, and anything that looks like it has a reasonable chance of producing both of them, I think is going to be highly favorable.
That ties into also what I wanted to ask you. I was thinking about with the tariffs, when people look at copper, how should they focus? Should they give special attention to companies in the US? Should they do something else? Any thoughts on that? Or is it really about focusing on that gold copper combination?
I would do that because one of the issues here, the economic issue, I don't want to get sidetracked in your interview, but people are starting to realize that what do we believe in Trump? Even if we go say we make a deal, is it going to be the same deal a week from now? So right now he said, I'm putting 50% and, copper and, all that. And there might have been some pre-buy-in and that might have helped. And the price here versus elsewhere in the world is short. But even if he drops that, what it's done is it's put the vision of what really the situation is in copper. If you're going to believe the happy people on Wall Street that keep buying AI stocks and driving it through the roof and still about electrical vehicles and stuff, they all need power that isn't readily available now. So we're going to need new resources of copper and other things that to be made. And there isn't an ample supply of it out there. And therefore that underpins the argument for it and where it's located. Canada, which basically forgot about itself for the last couple of decades and went elsewhere around the world, is now finally focusing and recognizing, hey, we're a key player in this critical mineral. We happen to have a lot of this stuff. And so now the politics and hearing people from Providence governments standing side by side with mining companies who they didn't want to be caught in a photo of 5 or 10 years ago with, because they were bad people. They do bad things to the land and all. Now are all unified and recognizing this and all. So the story remains extremely bullish for copper, uranium, gold, and silver.
That helps me, I think, understand the copper situation better. So thanks for going into that. And I don't want to sidetrack us too much either, but just while we're on tariffs and that kind of uncertainty, I know that you follow the BRICS pretty closely, and there's interesting things going on with the BRICS and tariffs. We heard about the 100% tariffs on BRICS mentioned quite a while ago. More recently, 10% tariffs talked about for BRICS allies. So I wonder, when you look at that, what does that tell you about how the US and Trump are seeing the BRICS right now?
Well, how he sees it and how the rest of the world is seeing it, I think, is two different stories, Charlotte. As you know, you're correct. The main thing that got me into gold in 2021, I made a decision that probably 1 in 50,000 people didn't do. I sold stocks and bonds just to own physical gold, mainly because I believed the price was going to be driven up because all these central banks were going to buy gold, because eventually they have recognized that trading, at least minimally among themselves, or eventually a new world reserve currency will have to come into play, and it will not be able to be a full fiat currency. It's going to have some sort of physical hardness to it. And gold was the best thing that they could see that it was. And that was the theory of owning gold, and it's played out. The BRICS story has only gotten better. I like to say that who's ever the head of new membership director for BRICS has to have a big smile on their face, because people have realized that Trump has taken a big stick into this trade war when he should have took an olive branch. And if you look at what he was saying weeks before and then days after he implemented his program, all of it was basically saying they're going to be at my feet in a matter of days begging for deals. Well, here we are, the middle of July, and there's no real deal of any consequences that's been done. Countries are now openly, including Canada, speaking opposition to it, that we're not folding, or, it has to be fair for us and all. Will he get something different than existed before? Yes. Will it be anything close to what he sold it on and what the stock market currently thinks is going to happen? No. And therefore, I don't think tariffs, while we're talking about them now, we'll be talking about them in the same manner 6 to 12 months from now, because I think what will be recognized by then is Trump's done more to hurt the long-term prospects for the United States than help. That's a minority opinion right now, but I'm kind of used to being the minority opinion in 40-something years. It's been the life of a contrarian that I've mostly been. But I do think if you look outside U.S. media and you look at financial media in Asia or Europe, they will concur with that these countries are moving away from the United States. And after it's all said and done, they will not have the same great, the Magna Group likes to say, make America great again. And they also like to think that somehow it'll be like it was 40 or 50 years ago. That's impossible. It's totally changed. And it sounded great, especially after the last administration, where those type of people couldn't stand for a minute for what they were doing. But I think a lot of things are being chipped away on Trump. And I think he has other issues now with Powell and this Epstein stuff and all, that he's just not going to have the influence that people perceived back in April that he could have regarding tariffs.
Well, and just to throw you a little bit of another broad question on the U.S., where are you seeing the economic direction right now as we move forward in 2025? There's so much going on. What are you seeing there?
Well, we just had the Fed beige book come out as you and I speak today, and it's again showing an economy that's clearly decelerating. Not to the point where it's falling off a cliff, but it's weakening on several fronts. I don't see anything. I mean, Trump can yell all he wants about we got to get interest rates a lot lower. Yeah, that's great, but look what happened by interest rates going to 0 or 1%, all the issues we have now and all. But separate from that is just cutting interest rates is not the reason, but there's a reason he's doing that a lot of people don't talk about. We have $10 trillion almost that has to be refinanced in the United States. If he could get it 1% or 2% lower, it would not be as bad for our debt and deficits as the case. But we have to remember one thing. When the Fed cut interest rates a year or so ago, the long end went up. It increased by 100 basis points. And that's because people are starting to realize, hey, not only is the United States never going to pay back this 37 trillion on our way to 50 trillion, they may start having problems paying our interest. We're going to want a higher interest rate in order to buy your debt. That's the big challenge. I say this often now, especially in our planning group when we talk with people. Folks, you got to watch the bond market, not just the stock market. It's much bigger, and it will have more of an influence on your economic and political life than the stock market will. And the bond market is continuing to suggest that the least resistance in rates is up, not down.
I think that's really true. I've been learning this year as well to hone that focus on the bond market because it's given some warning signs about what's going on. I think on that note, the note of inflation, interest rates, and what's going on, I know you posted today about these comments from Trump on Powell. Of course, we know that he wants Powell to bring down interest rates. And I Googled it just before we got on this call to see what is the latest on Trump and Powell. And I got about 4 different conflicting headlines about what is the deal there. So I'm not sure if there's much we can say about what will end up happening. But if Trump does fire Powell, what are the implications if that were to pan out?
Well, he's been talking under the belief, I believe, that he think he could force him out, that he would want him to resign. So the first story that ran earlier today, a White House spokesperson said Trump is preparing a letter to fire Trump. And the basis of it was going to be used on the fact that this new Federal Reserve building that they're building, that they've spent too much, he should have known better, and that would be the excuse. Stock market went down like 200 points in 20 minutes. And I know this guy watches, the president watches the stock market minute to minute because that's his bellwether. That's, the thing that he believes will show the world that he's doing the right thing and all. Suddenly then they came out and said, no, Trump didn't say that. Then they actually now have showed interviews where he said, well, I'm not really thinking that, but he made a real terrible poupée, whatever you want to call it. He literally says in an interview, well, he was a very bad appointment. Sorry, Mr. Trump, you appointed him back in your first. Now, Biden reappointed him, but if you never appointed him in the first place, he wouldn't be here now. That I think is a little hurting to him and all. But what are the ramifications? What will happen? For me, I would tell him, and this is what I would say to him, let him stay. People, why? If the economy tanks, if the tariffs don't work, the trade war doesn't work, blame him. He didn't lower interest rates. Okay? Let him go now, bring in your own guy, and it still doesn't work out? Oh, that's your own funeral and all. I don't think Powell is the type, I don't think he's ever liked Trump, and politics are not supposed to enter the Federal Reserve thinking, but if it came down to his thought that, well, if I just keep them a little bit tighter here more for another month or two, that doesn't help Trump, I think he makes that decision. That's just my personal opinion. But having said that and all, I think Powell and the Fed is closer to lowering interest rates based on what I saw in the Beige Book today. It won't be to the September meeting, but if we see employment, which there's a great discrepancy between the government's employment number and private groups like ADP. But right now, a weakness in the employment number would be the excuse for the Fed to loosen it. I suspect after what we'll start to hear them talk about is that they're getting ready for that and they'll look at the next month or two. But Trump seems to think that it needs to be done right away. And I don't think he's going to get his way. I think if he fires him, if he does make that move to fire him, he loses all credibility in the bond market, and that'll eventually hurt the stock market. Now, first, the stock market can go up, Charlotte, because of that. Hey, lower interest rates are coming. Lower interest rates are always good. For the stock market, you need to own stocks. That'll be the pitch from the Don't Worry, Be Happy crowd on Wall Street. But the bond people who recognize that listen, It was just a few months ago, if you remember, they were going to cut $2 trillion of the deficit. Remember those articles? Then it dropped to $1 trillion. Charlotte, they couldn't even get a $9 billion cut done in Congress. So now if we fire the Fed and all, and people think we're going to lower interest rates and print more money, that's Banana Republic 101. That's what the third world countries did in the 60s and 70s. And at a time when we're still running deficits and need foreign participation to buy our debt, here's a point, if you don't mind me take one more minute. They say, I didn't do the research, so I have to go, what others have said, about $25 trillion since the new millennium started, net has come into the U.S. securities, stocks and bonds from foreigners. As the dollar continues to weaken, even though it's going through a needed counter trend rally right now, some of that money will be pulled out. If we see this move and they become concerned about what we just pointed out and they start to pull out some more, interest rates can go a lot higher, even if the people in charge want to lower it, because we'll have this debt that has to be purchased and there won't be forbids unless we're much above. A lot of people think we're going to have to get to 6 or 7% on our long bond in order to keep supporting deficits where they are. We've seen bond prices decline 61% since 2020. When I was in the business, thank God I got out of it. But when I was in the business, bonds were where you don't lose money. Stocks, you can lose money. Bonds, you don't lose money. But people who did and bought back in 2020, 2021 have double-digit substantial losses. And so if we see more of that and rates have to go higher, the bond market can bring down the stock market. That is a very distinct possibility. We're not there yet. That's not something that's about to happen tomorrow, but it is something that you need to watch and keep an eye on.
This is so fascinating, and these will be definitely things to keep track of. I'll be interested to come back to you in the future and see how some of these things are playing out. I'll take us back around to commodities now, although I could listen to you talk about these other economic issues for a long time. I want to get your thoughts on uranium. So we know that you did well in uranium, and I believe you decided, okay, now you're going to be done with that. But you came back in, as you were saying. So what made you decide? What gave you the signal that this was the right time?
Well, I first got in. It was amazing that I worked in the metals and mining industry as a livelihood for 25 years, and I never played uranium back in those days. And there was a time when it ran to 100 and something, and these juniors went through the roof. But around 2019, 2020, I heard a gentleman who I still listen to back in the old days was still around. And he was talking about uranium at $20 and Cameco at $8. I said, what? So that's what initially got me in. I took a big step into it, bought a bunch of these uranium. My philosophy was and still is that the people that produce it or physically own it need to be owned first before the little companies that are hoping to find it. And that was the first go around. Cameco was my bellwether, and it ran above 100. And then the internet was just every 2 minutes, rocket ships and all these people sending messages how uranium's going to 200 and everything uranium is going up. I said, well, I've seen this before. So I got out, and fortunately it turned out. Then earlier this year, people that were uranium bulls were just like writing nasty things about themselves. They were so angry that it didn't do what they all thought, and losses and all this stuff. And I said, wow, the uranium story itself is finally getting better. Don't they realize that? And then I looked at the stocks and I just picked levels. I said, if they come back to these levels, I would buy them. And 5 or 6 of them did. But the story now for uranium, that story you might have heard for 3 or 5 years from before, the near perfect storm is here. First of all the things that should drive electrical demand up is happening. If you're going to buy the AI story and electrification story, then you need to produce the power. The United States, I can't speak for the Canadian power system, but I can tell you the United States here is so old in some places. I like to joke that Thomas Edison installed it. We are at the limit now. We need much more new power sources in order to provide standard power that people are going to need, let alone all this power for these centers and data centers and all this kind of stuff. Wind doesn't cut it. People are realizing that it doesn't work. Solar to some extent don't, because these big farms, if there's bad storms and everything, they get wrecked. 10 years ago, if you went to a United States senator and said, hey, I'm thinking about putting a nuclear power plant in your state, over my dead body. Now that same senator goes, please, can you build one? And could you build it fast? Now, the other thing that's happening is these smaller reactors, less deadly, faster potential to bring online, et cetera, et cetera. And what the bulls have always argued, the very limited supply and where you can get it. All of that has finally come together to really make the storm. But I still think you need to focus first on the companies that either are investing in it, physically own it, or are producing it. Now, there's not that many. That's the uniqueness. There's hundreds of mining gold companies and all. There's a handful of public companies that you can buy that produce uranium. But now those juniors can get played because real money's coming to it. So it filters down. It has that drop down effect and all. So I don't think uranium has to go to $200 in order to make money. I just think it needs to go back to where it was a couple of years ago, a little above 100, and these stocks will quadruple. I mean, Cameco, which is always still my favorite and owned, it's doubled basically since April. And it's still not expensive relative to what you could look at in some of the high technology stocks and all. So I would just say that if you're in uranium and you've been in it this long or still looking, it's hard to buy them when they've doubled in 3 months. But if you already own them, there's no reason to exit them at this time.
Well, and one more follow-up on uranium. So you did so well on the timing last time. I think a lot of people are looking at it. They may have faced some of that up and down in the market, and they're wondering, okay, so when do we get back to that level that we were at before in terms of the price and the stocks follow? Do you have any sense on that?
Well, like I just said, I think it would be logical, since the fundamentals are better now than they were 2 years ago, that if people were willing to pay $107 a pound, I'm sorry, 107, they should get back to that. The difference now is that there's much more eyes and investor interest in them now. As you can see, some of these things that Sprott and all come out with, they're oversold. They're able to raise substantial amount of money very fast into something that 10 years ago, most money managers would go, uranium, I can't put any money in that. Now they understand that story and all, but the fundamentals have changed too. This whole critical minerals that people are realizing around the world, that a lot of people who are dependent on things don't control their own destiny, that also drives it, because there's really no uranium production of greatness to speak of in the U.S., of course, in Canada through Cameco and all, but a lot of that uranium that is still needed is still coming from places that aren't exactly the greatest of friends with the United States and maybe even Canada at all. So it just has all the earmarks now have lined up. And I'm not a uranium bug. It's not something, I don't even represent or work with or do anything with a uranium company. But I do think the argument is the best it's ever been.
That is certainly good to hear on my end. And I think we've made it through all of your favorite commodities at the moment. But before I let you go, are there any final thoughts you would share with investors right now?
Well, I just think that I'll speak to Americans. I can't speak to Canadians because I don't know their day-to-day lifestyle. But one of the issues has to be is we have to start to learn to spend less than we make. The government's never going to do it first, but a lot of issues now, 66% of Americans are working paycheck to paycheck. They're not going to reach that beautiful commercials we watch of retirement and, spending your last quarter of your life living in some sort of luxury and all. But I do think things are going to get much tougher. Canada, the US, we're not going to be able to depend on government to do for us that maybe our parents 10, 20, or 30 years ago could, including things like here in the US, Social Security and everything. So it's very, very important to get your own house in order now. And one of the ways is to understand what is a necessity versus a luxury. One of the things that the internet and lifestyle and all, the generation now that thinks we should have all these things were incredible luxuries that no one imagined in the typical family 30 or 40 years ago. I think we need to go more back to that kind of lifestyle, because I think it's going to become tougher for us. And those of us that still have something, a lot of it's going to be from government trying to take it from us in order to support the masses who don't have it. Remember, the government doesn't produce anything. It just takes from one and gives to another. And the only two things that they can do in government is they can either cut expenses or raise taxes. And they'll be doing both of them for far as far you can see in North America, both Canada and the US. So I think we need to focus on getting our fiscal house in order. And once we've done all that, then let's look at investments and things of that nature and all.
Very, very strong point to end on. So thank you very much for that. And thank you for coming on today to go over all these different things that are happening in the markets. It was great to have you as always.
Always a pleasure to speak to you, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Peter Grandich.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.